Let's get right into it.
Get right into
Risk tolerance and long-term investing. Let's do
yeah.
this.
So the number one thing
Mm-hmm.
you should do before you invest is understand your own risk tolerance.
Mm-hmm.
You know what I mean?
Yep.
Mm-hmm.
And everyone's gonna be different when
yeah,
it comes to
and
risk tolerance.
I don't think any of us even thought about that when we were
Not
investing.
really.
Yeah.
really.
I didn't. Yeah,
Well, I kind of.
I don't-
I kind of.
Did you think about it?
A little bit.
I mean, I just knew that like whatever I put in, I knew not to expect too much, or anything can kind of happen, right? I knew that much, right?
I think like a lot of things that we have invested in so far, I think we've had so many collective wins
Mm-hmm.
that I think we haven't really experienced a true loss yet.
Mm-hmm.
Like especially like in the markets, right? So like
Mm.
I guess like that can long term that could fuck
I
you up.
mean, we've been humbled a little bit. I think we've been humbled a little bit.
A little
I think
bit, but
you
yo,
need to
like,
be humbled in everything.
you do.
Otherwise, you don't learn, and we wouldn't know what we know now if we weren't humbled a little bit. I mean,
So during those losses, if you were comfortable with those losses, then I guess that's your risk tolerance.
yeah, and I mean, your little foreshadowing into the next segment, the long-term investing segment. as well. But yeah, so anyway, so I'm not gonna go too much into risk tolerance because there's a great video on YouTube.
Mm-hmm.
But
We should make a video
a gentleman
on risk tolerance.
Yeah,
Yeah.
we should.
If you guys want us to make a video on risk tolerance, make sure you guys comment that down below, and while you're at it, like the video as well.
Yeah, but in the meantime, there's a gentleman by the name of Steve Antonioni
Mm-hmm.
Okay.
on YouTube, and his video is just perfect. It's like the only video on YouTube about risk tolerance when it comes to the stock market.
Were you talking about him when you said there's a sick guy online?
Yep.
Okay.
It's obviously going to be linked in the YouTube
Description
description below.
We'll put his links all down below. Yeah.
And this, I was just watching this video, right, just in preparation for this segment, and I was like, okay, there's no point of me even bothering because this guy just says it perfectly, and I'd rather just people just watch that, right? But essentially, the two main factors when determining your risk tolerance, number one is your time horizon, number two is the stability of your income, right?
Yeah.
So everybody's time horizon is self-explanatory, but let's just explain it anyways. It's how long are you okay with leaving your money
Yep.
in the market
Mm-hmm.
when you need it?
Mm-hmm.
When you
When
need to
do you
pull out.
expect to need to pull that out?
Mhm.
Right.
Exactly.
That's-
Yeah.
And
Yeah.
shit happens too. So
Yeah.
sometimes you might even have to.
You might
have no
be
choice, you have
putting
to.
money that you're saving for a vacation, or you're saving for your marriage or wedding or ring, whatever, right?
And
So-
that is
Yeah.
and I've learned that firsthand. Like, if you're expecting to to pull out your money on X date, that is not a strategy for success.
It's not.
Mhm.
You can't. You literally. There's a common saying. You literally can't time the market.
Mm-hmm.
Exactly.
Exactly.
So if you have a 1 year time, for example, you could have your time horizon could be 1 year, it could be 3 years, it could be 5 years, it could be 10 years, it could be
You'll
20
never know.
years.
Mm-hmm.
No, but like your time horizon is it's different for everybody, right?
Mm-hmm.
So
Yeah.
like if it's basically how long you're willing to wait for your returns,
Mhm.
right?
Yeah.
So
I would say like anything under a year is a little bit risky.
it's really risky,
Yeah.
but
Yeah.
you could pull out and it could be a bear market, and the market could just sell off.
Yeah.
Even if it's the best stock in the world.
Mhm.
But like, what if it's like obviously like we're not engaged in any of that right now, but like down the road, like if it were to be like home flipping, for example,
Yeah.
right? For home flipping, you can kind of time when you're going to be pulling out the money, because like if it's going to take 3 to 6 months for a renovation,
Yeah.
you can kind of be like, okay, I'm putting this money in right now. Within 3 to 6 months, I'm going to be able to cash it out, right? So like that's why I was like, I don't know if we were speaking about a specific like
We're speaking
the-
about
the stock.
just directly, stock market.
We're
Yeah.
speaking about very high level, like just for the broad, like average person that's venturing into the stock market or doesn't even know, because a lot of people, how they get into the stock market, like we talked about in the last episode, is someone tells them about a stock and they buy it. It goes up and then they're like, oh
Mhm.
shit, this is fun,
Mm.
right?
I mean, I'm sure that's most people's beginning.
Yeah.
You know what I'm saying?
Steps,
So
for sure.
and that's not really the actual
The
truth
best
of
way
it.
to do
Exactly.
things.
It's you got lucky. Congratulations.
Yeah.
Right?
Yeah.
You can keep trying it over and over again. You're
You're
gonna
at
get
the right
burned.
place at the right time, pretty much.
Exactly.
Yeah.
Right. Basically, you got to determine what your time horizon is before you invest, because if your time horizon is really, really long and your age, you say you're really young, you can afford to invest in high growth tech stocks kind of thing. Versus if your time horizon is like a couple of years and you want your capital to be preserved more, you could put your money into an ETF such as VOO or VFV in Canada, which tracks the S&P 500. And you can sleep well at night.
Yeah.
You don't have to pick individual stocks. You don't have to worry about, the CEO decided not to go into work today and now the company went under and shit, right? Like,
it'll be less volatile.
Exactly. And like, so it'll be up and down. Like, for example, like
it would be like smaller.
Like the S&P 500, like it had that little sell off at the when the COVID happened.
Yeah. Little correction.
Like what was it? I can't say COVID, right? You can't do that.
Yeah,
okay.
I'm gonna put the in there for that. Yeah.
If you look at the VOO chart and then the VFV chart, you can see that there's a little cliff. It fell off a cliff and then it recovered and went to all-time highs.
Yeah.
Right. We just finished going over Steve's video on risk tolerance.
Yeah, you guys can check that out. Press that box you see over there.
Yeah. So I just want to reiterate a couple things. Typically, someone who is comfortable with higher risk stocks has a little bit more time, has a longer time horizon, as Steve was talking about in the video. 20 years, 30 years. Tech stocks, high growth stocks that obviously you do your own due diligence on and you research, and they actually happen to be sound investments. You would look to invest in them for higher returns. However, if you're more risk averse and you have a shorter time horizon and if you don't want to take on as much risk, or if you have, for example, like the example that Steve gave where you want to get to $1 million by 50 years old.
Yeah.
You have $200,000 today. You do the calculation. You just need a 7% return each year for 24 years to get to $1 million. Nothing crazy. And in that case, if you want a 7% return, you can invest in VOO or VFE. Hey guys, hope you enjoyed that video. If you want to see more videos like that, click right up here. We actually have a full-length podcast. If you want to watch that, click right up here, and make sure to subscribe down here so you don't miss any videos. And remember, wealth is possible.